Hello everyone, my name is Sunday and I welcome you again for this channel against FX. Another episode here again today, and I hope you guys will really enjoy it, and I'm very sure and confident that this episode is another bomb, another eye-opener. All right, it's a step forward. All right, so like I said, my YouTube name is Against FX. How do you get Against FX? You just go to your YouTube, you search for this name, then you subscribe. Once you have done that, then you now go to the playlist, you will see beginners free course. Like I said, I'm offering a free course, 1 month free course, because I know there are a lot of people who don't have money to pay for trading course, and they are aspiring to be a trader and they don't have the money to pay for course. So I just thought about it and my spirit led me that, okay, do this. And that is why I am offering this for free. And the only thing is required of you, all right, is just for you to subscribe to my YouTube channel. That's all. Subscribe to my YouTube channel. It does not, since you have a data, you have YouTube app on your phone or your computer, maybe laptop, desktop, and all that. No matter the kind of phone you are using, except it's not a phone that has internet. But if it's a phone that has internet that you can use app, it's very simple. You just click, open your YouTube channel, your YouTube app, then search for Against FX. Then you see subscription to you see subscribe button. You just click it, just one click, and that's all. And if it prompts you to input your email address, you don't need to be scared. I don't have anything to do with your email address. It's just that it's a system that want to be sure if you are a human being or a robot. That is why you demand for your email address for verification. All right. And as simple as I want to impute it, that is if he requests. Some he doesn't even request, but if need be, if that happens to you, you don't need to be scared. You just impute your email address. That's all. Okay. And once you have done that, you activate. There's a best sign that you will see. You activate it. You know why? And that activation is just a click also, just for it to be active. As soon as I drop new video, it will be the first to be notified. And that's all. All right. You don't have money to buy course. Now I am giving it to you free of charge for a whole month. If you go for seminar, you know how much people charge thousands for seminar, just an hour. All right, you even go there, come back, you won't grab anything. I'm giving you this course for free. 1 full month. Every day I'll be dropping video. Every day I'll be treating a particular, I'll be treating topics till we wrap up this course. Then at the end of the day, all the topics that I've treated, you can now go back after you have studied, watch the videos, take notes and all that. You can now on your own, all right, now decide to do what we call deep dive. Open your chat GPT, type anything, it will give you answer. All right, you just take a deep dive into everything that I'm going to be teaching you guys this period. and you just see as you do, because the idea is for you to get the basics. You have the foundation. Then the rest is up to you. I'm telling you. All right. I pay for not even one. I pay for 3 courses while I was, starting up to learn trading. After the course, I didn't even know much. I have to pay another person, just like three. So the thing is that, and I'm happy today that after everything, I was able to now sit down. So I now sat back on my own. I now started training myself. All right. I now capitalize on the internet, watch videos. All right. Then I was now able to now stand on my feet, because trading is something that you have to read, you have to study. But what you need first is the foundation. Then the rest, you'll be just like somebody who's learning how to drive. All right? You have an instructor who will teach you how to drive. After that, by the time you now start driving every day, you drive to work, you come back, you go out like that, then you now discover that you now start getting used to it, because it's something that you are now doing every day. So it's the same thing in any field. All right? In any field, it's like that. All right? So you have to cultivate this habit of learning, improvement. All right? That is how trading is. And as you practice, that's why we even have demo. All right? Demo account. You create, it will get to a point, I will take you guys through it. You create demo account. Then you will now start demo trading. You will now start testing what you have already learned before you now move to a live account. Why is it a live account? Because you will now use your own personal money to open the account. Just like you going to a bank, you open an account, you now put money inside. So it's that money inside now that you will now be using to trade. If you want to buy instruments, you use that money to buy. If you make profit, it's your money. If you make any loss, and there's another way through Profem, where you have to go through training. You have to go through a verification, process for them to know whether you know what you are doing. And if you know what you're doing, if you're able to pass it, then they will give you money to be trading. You collect your percentage, why they collect their percentage. All right. So when we get to, you'll be exposed to so many things, and you'll be trading without using your own capital. That is if you know what you are doing. All right. And also an investor, if you are somebody that, okay, you want somebody to invest, okay. Somebody will invest, you trade for that person. You'll be using that person's capital to trade. And at the end of the day, people will agree on a term, on a particular term, how you are going to be on a percentage, how you are going to be sharing the profit. So it's like that. So that being said, today's topic is how to identify and trade other blocks. Guys, now we are going more deeper, because at the end of the day, before you know it, I will now start teaching you guys strategy. All right, rule-based strategy. Rule-based strategy. I will now be teaching you guys rule-based strategy. All right, the things you are going to be, how you are going to enter the market, how you are going to exit the market, when you are supposed to enter, when you are not supposed to enter the market, The things you are the things that you see, your checklist, rule-based strategy. I will teach you guys. Then, if you open your chart and those things, you check your checklist and they are not complete, you don't trade. That is it. By the time we get to that point, I will show you guys, and you now start trading on your own. All right. So, how to identify and trade order block? I have just a few slides so that for you guys to really understand very well. I hope you guys can see my what do you call it? My screen. Okay. If at any point you are not able to see my screen, please let me know at the comment section. And apart from that, I want to always be getting feedback as regards to our progress as we are progressing. All right. Any video you watch, please leave a comment. Let me know, okay, you've watched this video and this is how it is. This is what you find out. This is what you find out. If you are not clear on a particular topic, please let me know. If I'm going to follow it up with another video for more clarity, I will do that. All right. So thank you so much. After you have watched a particular video, you have taken notes and all that, please, I want you to leave a comment. And don't forget to share this video, because somebody out there is looking for this kind of opportunity. So please share it. If you have a page, you have an account, whatever medium, please share it. If you have a platform, please share it. Share these videos so that people who are looking for this kind of opportunity, they will stay key into it. As simple as that. It's as good as, okay, let's say, for example, you want to pay for a course. This is the same course you are going to pay for, and somebody is offering it for free. And anything I'm teaching you here, go and find out anywhere. I am telling you, what I do, I simplify everything. I don't just come and be teaching you textbook the way textbook say it. I will give you the practical way, the way you will understand it. There's no need blowing grammar to get people confused or to make it seem that it's too complicated. Yes, forex trading is complicated. All right, but you need somebody that will show you how it works. All right, you need somebody that will show you how it works. Then after this course, if you not feel, okay, I've gained so much from this guy, okay, be my mentor and show me how it really works practically. All right, show me how it works practically. Then I'll ask, okay, how much do you have? Pay me, then you will now be trading with me. You trade for some time, even if for you to be a doctor, all right, after your school and all that, you do what they call housemanship. You work with somebody with already practicing doctor, just even lawyers and all that, in all fields. In all fields, you must need somebody to show you how it works. All right. After the course and all that, then you can reach out to me. All right. No problem. So, order blocks, and we have types. All right. In forex trading, an order block is a powerful concept used to identify areas on the chart where large institutional traders, like, for example, banks or hedge funds, have place significant buy or sell orders. That is order block. Where institutions like banks, hedge funds, bigger boys with bags of money, where they place their own order. It's either a buy order or a sell order. That is order block. These zones often act as key support. You hear the word key. Not every support that is valid. So many support can be broken down. But when it gets to where the big boys have their order, they will protect that level. As soon as price come to that level, the price will have no option to start pushing back, because they will push the price back up. Or if they are coming from the top, or if they are selling, if price is rising, as soon as it gets to that order block, they will push it down. All right? So the zones often act as key support or a resistance level. All right? By now, we should understand what support and resistance level is all about. If you have been following me, you know that support level is a level where buyers will wait for price. As soon as the price comes there, get to that level, their orders will be triggered and the price will start going back up. The price will start rising. Then a resistance is a level where sellers will always wait, put their pending orders, waiting for price to rise and get to that level. As soon as price rise, get to that level, they will push the price down. All right? So these zones often act as key support or resistance level. And for you to recognize them, all right, you as a trader, retail trader, if you're able to recognize them, it will give you a strategic edge in the market. The ability to recognize where this order block, where the key support and resistance is, where the order block is, where these are big boys, the banks, the hedge funds, the men with big bags, with big loads of money, where they place their order, the ability to identify or recognize that level gives you a strategic edge in the market, because all you need to do is perform your analysis, do your analysis, single out the order block, all right? Then you place your pending order. I have taught you guys what orders, market orders, all about. All right? When I say pending order, I'm simply saying you place your buy limit order or sell limit order, or you place your buy stop order or sell stop order, which I have already treated. Those are pending orders, because once you place the order, you are not in the market already. And those instruments you want to buy, you have not yet bought it. Or the instrument you want to sell, you are not in the market already. You only gave instruction to your broker. Tell your broker, as soon as price rise up to this level, I want you to put me into the market. I want to buy. I am not buying now, but I'm waiting for price to get to this level. a certain price before you put me into the market. All right. So once you are able to identify and single out that level where there is order block, you put your penny on. And as soon as price is coming down to that place or price is going up to that level, once it get there, the order there will be triggered. Then price will now start rallying to the direction it's supposed to go to. As simple as that, even if you are not there, even if your system is shut down. So what is an order block? An order block is a price zone, all right, where a cluster of large orders has previously been executed, causing a noticeable market reaction. These blocks represent the footprint of institutional activity, and when price revisits the zones, it often reacts again, either reversing or consolidating. I've already explained it. All right. The way I wrote all these things is self-explanatory. Self-explanatory. You read it, you understand. All right. Another block is a price zone. It's a zone. It's a zone where a cluster of large orders has previously been executed, where banks, institutional bodies, hedge funds, the men with big bags, where they place their order. And how you will know that place? As soon as price get to that place, once their order is activated, triggered, or filled, is the same word. Once their order get filled, you will see the speed. That's why you will see a very big candle just move, causing imbalance. I've used that word before. Causing imbalance, causing fair value gap. I'm just giving you a secret for you to know where there is volume of price. Once you see a volume of price, all right, you will know that the big boys, they are there. And they always, the funny thing is that they always leave a footprint. All right? They always leave a footprint. All right? And that footprint is that order block. All right? So it's very, very clear. Think of it as the headquarters of big money moves. Institutions don't just hit the market with one giant order. They break it into chunks and distribute it across a price range and in form of consolidation. Is you see market consolidating, just going up a little, come down, go up a little, come down. There you will now see swift movement. Just like everybody driving towards a traffic light. You see everybody will slow down, all the cars will park. But once that thing, the light changes to green, you see everybody will just zoom off. Ooh, you see cars zooming off immediately. Once it changes to green. So that is how order block, you see all those, you see the big boys, they'll just be locking in their order. You see little consolidation to move a little up, you come down, move it. They are putting they are locking in their orders. And once it gets to the time they want to move, oh, you just see a very swift movement. All right? A very swift movement, just like somebody putting your car on gear 1, or you put it on drive, and then you just press the accelerator. The car will just move. So you see that movement, and that movement will cause imbalance, leaving fair value gap. That price will still have reason to come back and close up that gap. So that is how it is, guys. Then our next slide is the types of order blocks. All right. We have the types of order blocks. Order blocks are typically categorized into two main types. We have two types of order block. We have the bullish order block, all right, which forms after a bullish impulsive move. It will form after a bullish impulsive move. Indicates strong buying interest. All right. Look to buy when price returns to this zone. As simple as that. Once you single out that order block, the bullish order block, you will see that price will come back to that same zone, because it's that zone, that order block, that triggered the movement before the big candle appears. So I will show you in a moment. Then all you need to do is to place your pending order there, waiting for price. Even 1 day, 2 days, 3 days. If price did not come there, you don't need to worry. Price will definitely return back or revisit that zone. Any day price come to that zone, is going to trigger and you make profit. So it's like that. And the higher you go on the higher time frame, the better, the more reliable it is. Because the lower time frame order blocks are easily broken. But the higher time frame order block always hold ground. All right? That is not to say that the lower time frame order block don't work, but if you are to refine another block, let it be from the higher time frame, then you now start refining it down. All right? So don't just open a lower time frame and start looking for another block. No, you have to start from the higher time frame. That's why we have what we call top-down analysis. I think that will be the next topic. We have to treat top-down analysis. That is how you analyze market. All right? So the bullish order block forms after a bullish impulsive move, indicates strong buying interest. Now, when that happens, look to buy when price returns to this zone. Like I've just said, once we are able to identify it, place your pending order, wait for price to come there. Then the bearish order block forms after a bearish impulsive move, indicates strong selling interest. We have the bearish order block, we have the bullish order block. Indicates strong selling interest. Now, you look to sell when price returns to this zone. These zones are often identified after a breakout from a consolidation range from or by a strong directional move. When price returns to this block, it is seen as a high probability area for trade entries. Please, guys, it's very simple and clear. Once price break out of that place, because when they are lucky in their order, they will move a little, come back, push a little, come back. It's creating something like consolidation. Consolidation simply means price is not going up and it's not coming down. It's in a range. All right, it's just consolidating before it will now break out. It's either it's going higher or it's going lower. It has to break out of that range. So as they are breaking out, all right, they are leaving a footprint. The last candle before the breakout, before the push to the upside or the push to the downside, that is what we call order block. Because it's that one now that now triggered the push. After that candle, before the big candle. Why are order blocks important? Because it's important because it reveals institutional intent, their purpose, what they want to do. They show where big boys are likely to re-enter the market. All right? Improves trade timing. Help traders avoid false breakouts and chase moves, because once you are able to carry out your top-down analysis and you have identified where the order block is, you place your pending order. Instead of that, one will now make you trade with confidence, trade with ease, instead of chasing candlesticks. Oh, the thing is going up. Boy, I want to. No. You do carry out your analysis, single out that other block, refine it to your time of execution, all right? Then you place your order, and there you will now see where you are supposed to place your stop loss and your take profit. Put your entry, stop loss, and take profit. As simple as that. Instead of just chasing price action here and there. It's going up, oh, I want to enter. Now, when it's going back, you want to go back. So when you do that, price will come and meet you. You don't need to start running. It will come and meet you because you have already identified and singled out a place where institutions, where the big boys, they have already involved in the market, leaving a footprint. So therefore, price will come back to that place in future. Once we say future, it can be in an hour time, it can be tomorrow, it can be next tomorrow, it can be even next week. All right? So as a trader does not mean that every day you must have a trade. Some days you don't have a trade because you have a strategy that you follow. You have a checklist. If that is not met, you will not trade. Or if you set a pending order and if it's still valid, if the pending order is still valid, if it has not been mitigated, all right? Because there are some other block that has already been mitigated. If you are a baby trader, you don't know, you okay, this one is other block, you stay there. But you should know that if you're able to identify that it has been mitigated, that means that other block has been used. All right, you have to wait for another one. So those are the opportunity in the market that you have to always capitalize on. So that is that. As simple as that. And also it enhances risk management, offer clear zones for stop loss and take profit placement. Because once you single out all those things, we are able to identify them. You will see where you are supposed to put your stop loss without racking your head too much, you see where you are supposed to take your profit, because as the thing moves, turning point, that is a resistance level. If you are buying, then that is where you should put your stop loss. You don't need to be greedy in a market. All right? So that is how it is, guys. So at this point, let's go to our chart so that we can see what other block is all about. All right? So something like this is what? Weekly. This is the daily. All right? This is the daily. One thing that we must understand, for you to first of all know where other block is, number one, you must see a break of structure. There must be a break of structure. All right? There must be a break of structure. By now, you should know what BOS, or rather break of structure, is all about. Now, once you see that there's a break of structure, all right, like even here too, break of structure. Now, the next thing you need to find out is what caused the break of structure? What actually caused the break of structure? What caused it? What caused the break of structure? Here, what caused the break of structure is this guy here. This is what we call bullish order block. Because after this guy here, you see, after this guy here, we now see a very massive candle to the upside. This one is not normal. All right? It's not normal. It's not normal because if you look at this white candle here, this bearish candle, the low of this bearish candle to the high of this bearish candle, this other block here, you agree with me that there is a gap. That is what we call fair value gap. Fair value gap. Now let me take my replay tool and like this. Let me cut this one off because of training purpose. Look at it. After this push to the downside, this was the last bearish candle. All right. This very one was the last bearish candle. Then the next thing we noticed was this push to the upside. You see this massive push to the upside, leaving this fair value gap. We call it FVG, fair value gap, or imbalance. Imbalance. This is fair value gap. And now, after this push, before you now see a break of structure, all right? After this massive push to the upside, this is what we call fair value gap. And this is a sign that the big boys, they are involved in the market. This move will always cause imbalance. And apart from that, it will cause break of structure. That means this is the high. This push we take out this high, giving us another high. So let's take price forward so that you understand what I'm saying. So you now see this break of structure completely. All right. At the end of it, this whole move here, let's see where it ends. This whole move here took us up to this level. All right. So right now, if you are to wait for price, you are supposed to just come, place your order here, just little below this level, put your stop loss. Then this was in reverse, this level, where the price reverse. Then place your pending order. The pending order you are supposed to place here is what we call buy limit order. You remember what buy limit order is all about? The buy limit order, we have a high price. You don't want to buy because the price is still high. You set your own price and telling your broker, giving your broker instruction that you are waiting to buy here. The price is here is high. Because you are buying, if you want to sell something, you need to buy it at a cheaper price for you to buy, for you to sell and make profit. All right? So you allow the price to come down into discount level. Remember, I told you guys, when you are buying, you must buy at a discount level. All right? Then if you are selling, you sell at a premium level. All right? You wait for price to come to the premium level before you sell. If you are buying, you wait for price to come to discount level before you buy. All right? So in order block strategy, this other block as the topic I'm teaching you guys now. We have singled out the other block. Then this is the bullish order block. The bullish order block now is the last bearish candle. But don't get comfortable with last bearish candle, because this bearish candle can be bullish candle before these guys took over the market, took over the price, and now swiftly push the price to the upside. So it does not necessarily mean that it must be a bearish candle. All right? So if you put that one in your head and say, okay, it must be bearish candle, you might just be doing wrong analysis, because what you should know, what you should be concerned about is the last candle before this and before any push to the upside, before any big push, before any big movement, the last candle before it. That is what you should always pinpoint. Like here, this last candle before this. All right? So it's like that. All right? So you can see. And now you set your pending order, you wait for price to come in anticipation that as soon as price return back to this level, is going to trigger buy. And once it trigger buy, the next push is going to go above this place to give you another new price. But to be on safer side as a trader, for you not to be that greedy, your take profit should always be this high. All right? Because this price has already been established. If once this level holds and it triggers buy, that means the push to the upside will have to give us a new price. But you should not be interested in a new price, rather at this reversal point. This old price is what you should be targeting. All right. So all you need to do, set your stop loss order here. Remember what stop loss order is all about? To protect your capital. Now, your entry here, then your take profit here. Your take profit, you know, is you giving instruction to your broker. Once I make profit up to this level, bank my profit. Let my profit be in my account immediately. All right. So that is how it is. Now, this is what we call bullish order block. Then we have another one, because I told you guys that it's 2 times. Then we have another one we call bearish order block, right? Bearish order block. You can now see this one. You can see now price has been going up. Okay, let's use this one. Price has been going up like this. All right, look at it. What happened? I'm using this one so that you will see. You see, this is a bearish candle. This is a bearish candle. This is the last candle before this swift movement to the downside. So this is another block, and this is what we call a bearish underblock. Bearish order block. So I single out this very one because I know that this is what is a bearish candle. All right. So if you now make mistake and now go and highlight this one here, this bullish candle, because logically you might just say, okay, if a bullish order block is the last bearish candle, then in the reverse will not be the case. If you don't want to look for a bearish order block, it has to be, if you don't want to look for a bearish order block, it has to be a bullish candle, the last bullish candle before this push to the downside. Yes, you can say that, but sometimes it's not. It will not always be a bullish candle, or it will not always be a bearish candle. All right, because the one that is important is that the last candle before the push, before the strong movement, the last candle before the strong movement, that is the order block. So it's very clear. You must know that. Don't just come with this idea that, okay, bearish order block must be the last bullish candle. Then bullish order block must be the last bearish candle. No. But you will see sometimes it just happens that the last bearish, the bearish order block, you just see, okay, you just see a bullish candle there before they push. Okay, it's all right. But it's still the last candle. Also, a bullish order block, you will just see, okay, it's the last bearish candle before they push to the upside. It's okay. But don't have only that in your mind so that you won't get confused when you are doing your analysis. Just know that, okay, the last candle before the push. You see this one now? All these are consolidation that we are talking about. The price is not going up, you see? It's not going up and it's not coming down. It's just on this range. Where is this one? It's just what? At this range. Look at the range. Between here to this side, this is where they started locking in their orders. locking in their orders. Because the money they have, they cannot push everything into the market once. No, it's too much because of their lot size. So what they do is they will be putting it bit by bit, therefore pushing the price up, push it down, push it up, push it down, push it up, push it down. Then the next thing you hear, boah, the thing will just strike to the downside. If their aim, their purpose is to push the price down. And if they are to push the price up, is still the same thing. They will lock the price, they'll push it into a kind of consolidation. All right, this is what we meant when we use the word consolidation. It's just locked in a channel. It's not going up and it's not coming down. So they are at that point, they are locking in they are offloading their orders. All right. Once everything is set, the last one is going to be a bomb and the thing will just break out of this consolidation, you see. Once. All right. So I hope it's very, very clear. I hope it's clear, guys. I need you guys to always drop your comment at the comment section so that I will know that you guys are really following what I am teaching. All right. So I know that you guys are following what I am teaching. Like I said, don't just have it in your mind that bullish order block is the last bearish candle. Yes, it can happen. Like in this case now, is the last bearish candle. But this bearish candle, in some cases, it might be a bullish candle. Will you not say it's not another block? It's another block because after that candle closed, the next candle was a bomb. The next candle gave us a very massive movement. All right, it created a very huge gap. Difference. Let's say price is at $50. Then when they entered the market, they took price to $250. Something that was $50, they took it to $250. That is what we are saying. And the only people that has the power to do that are the banks, hedge funds, those financial institutions, and the bigger boys with bigger bags of money. They are the people, when they want, they don't just come to the market every day. Anytime they want to offload, they want to trade, it's massive, big money. So if you are able to always, if you know how to do top-down analysis and you're able to single out or identify the other block, you just mark it, set your pending on. Any time price come to that point, to this level, it will return. It will return. Even if it returns and at the end of the day it start coming back, but it must respect that level. It's going to push. So that is how it is, guys. So on this note, I will say you guys, congratulations. If you have been following me up to this point, I will just say a big congratulations because you are really grabbing so many things, but you won't understand now. You will understand later in future. This is just, what do you call it? If it's a free course that you are not paying for. So it's an opportunity for you. It's an opportunity for you as someone who is learning or interested in trading forex. So that is how it is. And you can now see this very one here now. This very one here, now the price are pushed up to this point and it came down, touched this point. What happened? You see this massive push back, and it's pushing now. It's pushing, it's going back. It got triggered and it's going back up. This is the work of another block. As simple as that. And I tell you, me, I'm on this trade now. I'm just saying it. I am on this trade. This US 500 or S&P 500 is the same thing. All right. I'm on this trade. All right. So you see, this is another block, and the K price came up to this point. It tapped in. Then you now see this massive move. If you scale down, you will now see the difference, because we are on daily chart. You just see, you think nothing is happening. This push that gave us this what do you call it? This pin bar. This is a sign of what? Buying pressure. I've already thought on that. So if you are watching for the first time and you are confused what buying pressure or pin bar is all about, when I treated candlestick anatomy, all right, I simplified everything. So once you see something like this, you will know that this is a buying pressure. If we scale down to far, you see this movement? But the only thing you saw just now was just one candle, one candlestick, right? You see, like this. All right. If you scale down to 2 hours, you see all this movement. Now you see where price has gotten to. If you scale to 1 hour, you see one like this, breaking structure to the outside, push like this, gave us change of character, break of structure, another break of structure. Now it's retracing. All right, it's retracing. This is a retracement. After a retracement, because price has given us a new price from here, after the pullback, it has given us a new price, breaking structure. This is just a bonus. Let me just, oh God. This guy, you don't understand. This thing I'm teaching you guys now is just a free something, but this is a live something. Once you grab the concept, you are okay. This market shift. Why? Because after this resistance, price pulled back to this level, and now after when it got here, it tapped into the other block and it's going back. It now started going back, breaking above the resistance level. Now we can take this. Okay. We can use this because there's another break of structure here, right? We can use this. We can use this to say, okay, this is where change of character happens or market shift, because if you look at it critically, you discover that this point here is what? Our last break of structure. Guys, this is how to analyze price. This is how to analyze chart. Then this one here, break of structure. For you to know what price is doing, as you are doing it like this, you know, okay, after this, this is what will happen. After this, this is what will happen. Now, what happens here? Another break of structure. Anytime there's a break of structure, that means price has given us another price, another high price. All right? It has given us another high price. This Y here. All right? Now there's a pullback. The price is pushing back. On no account should price violate this level. As it's coming back, now anything that makes this price to pull below this level, just take your profit and now wait for the next action. Because it's bullish, it's supposed to pull back, have a retracement, then create another. After a retracement or a pullback, guys, anytime I use retracement or a pullback, means the same. After this retracement, because this is the state we are now in the market on this price, is what we call retracement, or you call it pullback. And once this phase is done, the next phase is going to be a push phase. A push phase to give us another high price. Because right now, this is the current price. And price is retracing. As it's retracing, that means this high price now, price is coming down, something that is $50 or $100. Okay, let's use 100. Something that is at $100 now is coming down to $60. That is retracement. Once you get to a support level where buyers, what is support level, guys? Drop it at the comment section, please. Once you get to a support level, there will be a push to the upside. The push will now take the price from $50 or $60 to let's call this place $100. You will now take price from $60 to like $120. Then it will come back again. At any point, you now see that this push now, for example, this retracement violating this support. When we say violation, we are simply saying if price should pull below this level, that is what we call, drop it at the comment section if you know. Drop it at the comment section. Once it breaks below this support level, please drop it at the comment section if you know. All right? Drop it at the comment section. Once price violates a support level, a price that is an uptrend, if it violates a support level, what is it called? And what do you need to do next? All right? But for the sake of those who are watching for the first time, if price at any point violates a support level and we are on uptrend, meaning that after the change of character, price started breaking structure to the upside, creating a higher price, a higher price, a higher price. But at any point where you now notice that a retracement now violated or violates a support level, you should know that something else is about to happen. And once that happens, you should know that there is what we call a market shift. Once that happens, it has given us, price has given us a market shift, preparing us that very soon we should be preparing to start buying. The price wants to start to sell. That this level here, sellers are much. Plenty sellers are here. They are pushing the price down. All right. The sellers want the price to go down. They want the price to go down. All right. They want the price to go down so that they will sell. Then when price get to a level, a support level that will be able to withstand the sellers, then they will buy there and start pushing the price up again. All right. So it's like that, guys. On this note, I say thank you guys so much for your support. I've seen so many people are subscribing to my channel. I'm not taking it for granted. So thank you so much. And be very, very serious with your with this course, right? With this course, because it's not something that comes every day. If you see somebody that's just okay, the person just decide to just offer this kind of a thing, is an opportunity. All right, so you have to capitalize on it and take it in a very serious manner. All right. So thank you so much, and I wish you guys success in your endeavor as you are learning or training this part. I believe good things will come your way. But the only thing is that you need to be very serious with it. That is the truth. Anything you are doing, let all your mind, your soul, and your spirit be in it. All right. And you must have a Z for it. All right. It's not when you are doing something and you are complaining, it becomes problem. But if you are doing something that you enjoy doing, all right, it becomes simple. So thank you so much. And on this note, I'll see you guys again in the next episode. Bye for now.